Howdy, folks. It is Dr. Jeff Camarda. Good Friday afternoon, August 21st. I apologize for the glare on my face and my glasses, and my hair's a bit disheveled, but I do have some important information to pass on to y'all. So please pay attention, and I'll try to get through it relatively quickly. But this will be a longish one now that we're kind of going through just a couple of videos a week format. And this is important stuff. So the first is mark your calendars. We'll be doing another class Thursday, September 3rd at 11 o'clock. And again, it's 6 p.m., 11 a.m. and 6 p.m. And this is on asset protection and risk management 101. This is stuff that every consumer should know about protecting their assets and their wealth. We'll be talking about the different kinds of insurances and basic asset protection techniques. And again, please mark your calendar. Actually, accept the registration invitation, which you should have received now. And please do pass it on to friends and family. We get really rave reviews from the classes. And even if they never would consider becoming a client of ours, I think they'd find a lot of value in it. So please share this wealth of information, if you forgive the pun, with those that you care about. Okay, so next thing is we're going to begin to deploy under the new Camarda Tactical Opportunity protocol that we've been developing all summer, and you should have gotten some notification on. You saw Kim's video earlier this week. And the first phase of that will be looking to basically ride momentum both up and down. And this up momentum may continue for some time to look to take short-term profits there, but also opportunities to profit on the downside. Using asset classes that are negatively correlated with the rising stock market. Basically, that means that they should go down or should go up when the stock market goes down, and with relatively fast triggers based on certain indicators. So you'll be looking for some changes across the portfolios, except for any of those of you that have asked us to freeze your portfolios and not participate in Camarda Tactical Opportunity, and those trades should be beginning next week. So I don't have to tell you the market continues to soar to record levels. My goodness, this is just wonderful. And I've got some comments from, actually before I get into that, we hit another economic milestone, or maybe a millstone, which was reported today. The U.S. debt has now, for the first time in history, exceeded gross domestic product. That means that the U.S. government owes more than the entire economic output of an entire year of the U.S. economy, which is a pretty big number. And this has always, in the past, been associated, gee whiz, if that ever happens, we're really going to be doomed. It's going to be, Banana Republic, the currency devaluation, all this other horrible stuff. And, I'm not sure what's going to happen. I don't think it's a good thing, but in the modern monetary theory, which is espoused particularly for some of the more progressive economists out there, basically says that a country can print its way out of stuff like this, just print as much money as it wants to, and inflation and bad economic consequences are really nothing to worry about. So saith the proponents of modern monetary theory. I don't quite agree with that, and I think that it's probably a bad sign that we owe so much money and the printing presses keep on running. All right, so I've got some commentary from Barron's about the current level of the market and what it may bode. And I obviously, that I think that this is unsustainable frothiness, and we have a reckoning, and the market will give us a significant downturn or plunge even into new bear lows. But I'm quoting, from a Barron's piece from Randall Forsyth, who's up and down Wall Street, a very brilliant financial columnist. And he says the disparity between the equity market and the real economy, which is struggling to cope with the coronavirus pandemic, remains stark. While millions of people have lost their jobs and tragically more than 160,000 Americans, more now, have lost their lives, sentiment is nothing if not frothy. That's evident in the very vigorous public participation in the market, remarks somebody's quoting here. More than the massive rise in tech, megastock tech names like Microsoft, Apple, them all. Froth was evident in the bidding up of recent stock splits, which made even less sense than the rush into bankruptcy stocks, which are people loading up Robinhood type investors in companies that are going bankrupt. Go figure that one out. Splits and really why those of us in the business find splits amusing is if you take $1 and you split it into 4 pieces, you now have 4 quarters, but it still add up to $1. So a stock split really doesn't change the underlying valuation, which is why it's kind of a hallmark of exuberance and an overvalued market. Further evidence of irrational exuberance that recalls the splits, the frenzy of the dot-com bubble at the turn of the 21st century. You remember what happened, Y2K about 2000, stocks really run up on NASDAQ, eBay, I think, or rather Yahoo at that point was trading at price earnings ratio of 700, and it took years, and it really is a profound plunge, took years and years to recover. That's what they're comparing it to. More important, the disconnect between the stock market and underlying fundamentals is unequivocally at the greatest in the past 30 years. Just going to get to another screen here to continue with my script. Indeed, the S&P 500's valuation at 26 times expected earnings. At the same time, the economy confronts the clear and present danger of a relapse, makes for a very significant headwind, Barron says, as even before considering the political season ahead, which promises to be vicious, in which the invective will only get nastier and continued wrangling over much needed relief for households will persist. They haven't figured that out, by the way. A lot of folks out of work, having trouble paying their bills. I get a lot of tenants that are in that camp, and I can tell you collecting rent has never been less pleasant. And then there is the inexplicable but persistent tendency of the stock market to get battered in September, which of course is right around the corner. So it seems apparent, ending this Barron's bit, is that investors have embraced the view of Dr. Pangloss, who famously asserted in Voltaire's Candide that this is the best of all possible worlds. And those of you, and I say this to my dad, who turned me on to Candide, and my 17-year-old son, so it's a brilliant satirical book, very short, very easy. You should read it, Candide. And the things that happened to poor Candide, the horrible misfortune that unfolds throughout his entire life. But this is the best of all possible worlds. Can't get any better. And they're comparing that to where the stock market is. Okay, so next seg is into looking at potential tax ramifications. And again, I want to begin by saying I am apolitical. People ask my political party. I'm a capitalist. I think there is good concepts on both sides of the political fence. But I'm talking about candidate Biden's tax proposals, and how they may impact you as investors, regardless of how you feel about his candidacy or the good that he wants to do. But his plan lays out very specific principles. It focused on eliminating the benefits offered by the recent tax reform a couple of years ago, and includes additional measures to raise revenue. He would focus on the top 1% of earners. That's most of you watching this, top 1% of earners, by returning the top marginal rate to 39.6%, about 40%. That's where it was before tax reform a couple of years ago, roughly at the 99th percentile, which some observers wonder maybe explain why the Biden campaign chose that income level, because there's not many voters in that percentile, but a lot of money. In an effort to shore up the Social Security system, he's proposed subjecting income above $400,000 to 12.4% Social Security tax, also known as the payroll tax. For those of you high earners, that's huge. That's going to be on top of the 40%, and on top of the Medicare and other taxes, that non-Social Security tax. For salaried workers, the tax is split. That. Biden also proposes to change the long-term capital gains tax rate on investment income exceeding $1 million. Any profits that exceed $1 million would be taxed at the ordinary income rate of 39.6%, probably plus the residual Obamacare tax, which is mentioned here. But again, that takes the long-term capital gains rate, my friends, for those of you that may be exposed, and doubles it from 20 to your highest marginal rate. That's a really big deal. And there's also some proposals floating out there, by the way, which hopefully don't make it to law, to impose a capital gains tax on unrealized income. What is that? Unrealized capital gains, really? What does that mean? That means the value of your portfolio goes up. Even if you don't sell, you got to pay a tax. It's kind of like a personal property tax or a real estate tax on the value each year. And gee whiz, what if the market goes back down and that gain evaporates? Think they'll give the tax money back? I bet they won't. I bet they won't. Um, Deductions also for top earners would be limited under Biden's plan. Currently, only 10% of taxpayers itemize deductions, but that's about half of high-income folks like you. So that would be a major tax increase for some of you. And this is really probably the most disturbing aspect in keeping with his focus on the wealthiest. The estate tax and wealth transfer breaks are also in his crosshairs. As you probably know, the current tax-free amounts for a couple is about $23 million. That's 11.6 million per person. You got two of them, that adds up to about 23 million. And that, by the way, is going to, under existing law, is going to go away in 2026. So, if you haven't taken advantage of that using some of our family bank ongoing trust type planning, trust planning to get large amounts out of the taxable estate, you better, die soon, because you're actually not. But Biden's proposal is going to drop that back down to 5.4 million. So basically what that means is the amount that you'll be able to pass is going to drop by about 75% over the next few years, and probably go down even more than that. Perhaps the most aggressive aspect of his plan scraps, so this is even more disturbing, the step up in cost basis on inherited investments. Currently, when heirs inherit something, as you probably know, if I bought a share of stock for $100, I hold it till death, it's now worth $10,000. If I sell that while I'm alive, I've got to pay tax on a gain between 10,000 minus 100, or almost all of it's on gain, right? If I leave it to my heirs when I die, the tax code makes believe that they pay 10,000 for it, not 100. So if they sell it for 10,000, there's no gain. They're basically getting their money back. That's what a step up in basis does. But this proposal would eliminate that and basically impose capital gains taxes in addition to estate taxes at death. That's pretty scary. As for businesses, Biden would raise the corporate tax rate from 21 to 28% and enact a 15% minimum book tax, a levy on income, net of expenses for corporations with income in the high millions. That would not affect many of you. And then also raise the corporate tax rate. So I think that's probably enough on this. Let me take a quick look. This is also, there's some more detail there, but in summary, this is important. Biden's tax plan would slow economic growth because of the way the plan raises revenue. For example, increasing the corporate income tax rate and minimum book tax raise the cost of making new investments in the margins, which tends to reduce long-term economic growth. So obviously, if these things are imposed before the COVID recession/depression passes, that would be slow the recovery, make it more painful and longer to get out, and also reduce overall tax revenue as corporations make less money. Now, I need to emphasize these are just proposals, so don't get too excited. Nothing will happen until Congress enacts legislation and a president signs the legislation. There's a lot of ways it could go. Biden, while he's leading the polls now, may not be elected. He may not have a Senate majority. There's a lot of different ways to spin this, but there is certainly fire on the mountain that you should be aware of. Keep a close eye on it. And the prudent among you, especially from an estate tax standpoint, will muster and put some estate tax control devices into your planning, even if you're not exposed under current law. I am convinced in the years and decades to come that the estate tax will become very, very fierce. There's an opportunity under existing law to basically eliminate estate tax, even for folks that are worth tens of millions of dollars now under current law. If you take advantage of it, make hay while the sun be shining. Sorry that went on so long. My goodness, over 15 minutes. Please forgive me. Until the next salient bit, until there's something worthy of reporting, I wish you peace, prosperity, be kind to one another. And anyway, thanks for watching. Have a great weekend. Bye-bye.